We got a pulse check of the consumer this morning with March retail sales falling 1% from February as people pull back on spending despite inflation data showing signs of slowing. ADP Chief Economist Nela Richardson joins us now. Great to see you and get some of your insights as always. Really take us into your reading from this particular retail sales data and what it tells us about the consumer right now that's trying to still be healthy or resilient, as bank CEOs would say they are, while still trying to navigate a very moderating economy right now.
Well, hi, good morning, happy Friday. And I think what the data tells us is that the consumer is still in pretty good shape, that consumer spending is likely to still provide upward support for first quarter GDP, but higher interest rates and higher inflation are taking a toll. Now, you noted the 1% declines. Some of that might have been that January and February were warmer than expected and people were out and spending more. And so that spending took place earlier in the quarter, and the March is reflective of that. One of the big drivers of the decline was motor vehicle sales, 1.6% down from the previous month. And, we've seen that indicator of auto sales really be sensitive to supply chain shortages, also now sensitive to higher interest rates. So dealing with lack of supply on last year, now transitioning that downward spending to higher interest rates and maybe not wanting to take on an auto loan at this time. The consumer is trying to navigate a lot right now, but still fairly resilient and still fairly supportive of GDP growth.
Nela, has the economy felt the full impact of the Fed's rate hikes?
Not in my opinion, no. I think those are lagged, and we all understand that. Interest rates are higher. They're not high in terms of historical trends. In fact, they've gone from basically rock bottom levels of 0 to around 5%, but they are high in terms of how quickly they've gone up. And I think that sticker shock on interest rates is still being reflected in the economy. And as a data point, I would note the recent New York Fed survey tying interest rates back to inflation. That consumer expectation survey said that consumers are still expecting higher inflation. It went up again. And so there is a balance here between higher interest rates slowing down spending and consumers' expectation that price growth will continue.
To what extent is the expectation of price growth and the actual kind of incurring of price growth, because it's still a purchase decision that consumers make, whether on the necessity or the kind of discretionary side there. But as we've seen some of those discretionary dollars start to wane a little bit, it is a matter of where they're pushing back on price, where we're seeing more discounting, and where consumers also might feel confident in the wages that they have too. So if there is a correlation between those wages and between where inflation is still sticky, what is your reading into that?
Inflation, it's a great question because inflation has morphed, right? It started with a supply chain shock, but it's being amplified and held up by increased wages. For the worker, though, the translation doesn't matter because they're still seeing their dollar go less far on average than it did a year ago. But what we're seeing in terms of payroll data is that our wage growth is starting to decline. That's good news for inflation. The question is always a horse race, though. Is inflation dropping faster than pay growth is dropping? And that's what makes workers able to spend more. Right now, spending still looks supported, but inflation hits low-income workers, low-income households the hardest. And they're not just dealing with discretionary issues. They're dealing with things like food, which we know has seen really outsized growth in terms of prices over the last year. So that is still weighing on low-income households. Yes, they've seen the fastest growth, but what they're spending most of their budget on, food, shelter, things that you can't substitute out of, those of what we've seen in terms of consumer prices really take flight.
Are CEOs or companies, I should kind of broaden that out a little bit, are companies right now continuing to try and push a supply chain issue type of story or narrative, or them needing to pass on more wages type of story, in terms of the amount of prices that they're continuing to keep elevated right now? even in the face of consumers saying, you know what, we're kind of pushing back on that price, are they doing it to kind of maintain their own margins? And, you know, how do you expect consumers to continue to respond to that if they indeed find out that, hey, the supply chain is just fine now? Stop using that as almost an excuse.
You know, I think it depends on the company and the size and the industry. For small firms, finding qualified talent and keeping up with the wage increases has been top of mind, a front burner issue, much more than supply chain issues if you're in the service sector. So for small firms, it's about wages, wage growth, and the competition for talent. For larger firms, they've pretty much overcome the period where there is an immediate hit to supply, that these supply chain shortages had to be dealt with real time. And they're dealing with a structural change, a longer term change, rethinking supply chains in a more strategic way, which will add cost if it increases resiliency. So every company, depending on size, are on a different part of their journey when it comes to prices. But when it comes to the consumer, you know, consumers don't care if you're raising prices because of higher labor costs or raising prices because of supply chain woes. When they're in the grocery store, when they're in the department store, all they're seeing is the higher prices.
All right, that is ADP Chief Economist Nela Richardson. Great to have you here with us today, and especially as we're continuing to keep a close eye on where some of the economic data readings continue to trickle in, of course. Thanks so much for joining us.